Alright, now let's continue our analysis. This is the one we analyzed a moment ago. We had an upward trend, followed by a break, then a first wave, another break, a second wave, and then a sideways phase. After that, a reversal occurred toward the downward trend. But before we proceed with the analysis, we need to discuss the probabilities of completing a full price movement cycle. What are the probabilities of a complete price cycle? In a full cycle, everything mentioned earlier refers to the complete price movement cycle, which is considered the ideal cycle. This occurs under normal conditions and in a strong trend, characterized by one market side, either buyers or sellers, dominating the movement. Typically, the price remains above the exponential moving average, 21 EMA, in an upward price movement cycle and below the 21 EMA in a downward price movement cycle. When looking for entry points, one should always position against the weaker side and in favor of the stronger or controlling side of the market. The only exception is during the final reversal stage, where entries are made upon recognizing the failure of the dominant side to sustain the price movement. We will study moving averages in detail, covering their setup and strategic applications. What about an extended cycle? An extended cycle occurs when the reversal stage does not happen. Instead of reversing in the opposite direction, the primary trend continues with a new channel in the same direction, meaning the trend extends, forming a larger price cycle with a larger ascending channel that awaits a break, followed by a first wave, a second wave, a sideways phase, and then the reversal. Extended cycles occur when the trend is extremely strong, clearly dominated by one side of the market, with the absence of any resistance from the opposing side. In a bullish extended cycle, the price generally remains above the 21 EMA, while in a bearish extended cycle, it stays below the 21 EMA. Similar to a complete cycle, trade entries should always follow the stronger side and move against the weaker side. What is an incomplete cycle? An incomplete cycle is one that fails to complete one of its components. This happens when the price reverses at an unexpected stage, canceling the next phase. A cycle may be incomplete due to the absence of the second wave or the sideways phase. Incomplete cycles often occur in weak trends, where no dominant force controls price movement. Buyers may take control for a while, only for sellers to regain dominance before buyers step in again. A key indicator of an incomplete cycle is when the 21 EMA is nearly flat, with prices fluctuating both above and below it, forming an overall wide sideways range. In an incomplete cycle, trade entries should only focus on opportunities within the first wave, following the direction of the most recent price movement cycle. Alright, now some of you might be wondering and asking, isn't what we analyzed earlier considered the ideal price movement cycle? As we can see here, after the sideways phase, a downward trend occurred, right? And this aligns with the ideal cycle in analysis. I would respond by saying that we are missing key elements that we cannot clearly distinguish in this downward movement, such as the break, the first wave, the secondary break, the second wave. At first glance, it may seem that this downward movement lacks the necessary elements of a complete price cycle, doesn't it? Someone might be waiting for a trade opportunity in the second wave to secure their profit. But wait, let's take another look at the downward trend. If we adjust the chart slightly, we will see that there is a break, followed by a first wave, then another break, then a second wave, and finally, a sideways movement before a reversal towards the upward trend. I want you to analyze for yourself, build confidence in your readings, and always reassess your chart interpretations. There will always be traders with incomplete knowledge or a lack of experience in technical analysis. I don't want you to be easily influenced by others' analyses. Yes, expose yourself to different types of charts and various trading strategies. This will enhance your market vision. But your ultimate goal should be to identify weaknesses in external analyses and rely on your own insights and strategy. Consider this a preparatory introduction to what we have covered so far, allowing you to develop a stronger, more logical approach to technical analysis across different price movements.